Hello, everyone, and welcome. Thank you all for joining us today. We have people coming in, and so we're going to give it just a minute or so to allow people to join us, and then we'll get started. Will you accept people once we get going?
Yeah.
So, how do I do that? There. All right. Well, as people continue to file in, we want to go ahead and get started. And again, thank you for joining us this morning. From our entire team, from Andrew and I, we hope that everyone on the call that's listening is safe, that you and your loved ones are safe and healthy during this time. So we have a lot to speak about today. And with that in mind, we also want this to be as interactive as possible. So through Zoom, and again, this is our first time using this, but through Zoom, we have enabled the chat function so that you can type in questions as you're listening to not only what I may be talking about, but as Andrew speaks and gives his market update and talks more about our process. Please reach out, ask us questions. We are also recording this. So if you go back and listen, or if you weren't able to make the call and you're listening at a different time, please email us your questions. And we'll be happy to answer those on a one-off basis as needed. So again, thank you for being here and thank you for being a part. First thing I want to really dive into is just a quick firm update. I mean, there's a lot of things been going on in the world. Obviously, small businesses all over the country are feeling different effects from what's going on. But I do want to first let everyone know and really thank everyone. We just, on Friday, we had our 1-year anniversary, March 21st, which is extremely exciting for our team. But we also know we couldn't have done it without each and every one of you, clients, family, friends. The amount of support we have received, we could not be more humbled and more grateful for the response that we've had over this last year. So thank you so much. As a team, when I talk about our team, not only for the partners, but also Christy Childress and Thomas Keeling, as a whole, there are so many things that I know I'm thankful for, that each and every one of us do to make sure that we're taking care of our clients and friends on a daily basis. To that same extent, after this meeting, Andrew and I will be leaving the office, and I'm sure as many of you know that the Dallas County has issued a shelter in place, and so we will be complying with that, and our team will be working from our homes. But as I have spoken with many of you about, and I know Kramer, Andrew, Thomas has done as well, we have invested in technology to allow us to do this and allow us to continue to work almost as business as usual. And thankfully, because of that, we are going to be able to continue to move forward from a trading perspective, taking care of requests for money movement as those things may be needed. And so we are here for you all, whether it be via email, or phone. Our phones are being forwarded. We do have those opportunities for you. Also, as far as business continuity, not only for us internally, but our many partners. As we are working from home, we are continuing to monitor and work with our technology partner to make sure that cybersecurity, that our firewalls are up and are running, to make sure that your information is protected no matter where we are working. And that is something that we will continue to watch, as that is of utmost importance to us. Secondly, is the assets that you have placed in our trust, and those assets being held at 2 of the world's largest custodians, no matter custodian, bank, wirehouse, Charles Schwab and TD Ameritrade. We are in constant contact with them, both with their wire and money movement departments, but also their trading departments, to make sure that we are getting, if trades are needing to be made, we are able to do those being large corporations as they are, they do have facilities and offices all over the country, and are continuing to work, take calls, and be there as needed. So just want to make sure that we assure you of that. With that in mind, many of you joined this call, and I know you want to understand and get a perspective of what's going on in the markets. We're hearing a lot of talk, whether you're watching the news, because we have a lot of downtime right now, and the Fed's doing a lot of things. What's going on in Washington, and how are the markets reacting? Why are the markets reacting the way they are? And so I really want to spend the next few minutes with Andrew, who's going to speak to that, how we're positioning our clients and our portfolios today, and how the Delos wealth management process and the construction process works to not only find those opportunities and grow your assets in the long term, but also make sure we're looking at today and making sure that those dollars are there in these times of uncertainty and these times of stress, so that you and your families know that we do have liquidity and are available to make sure that food's on the table, lights are on, things of those nature. So Andrew, please take it away.
Yeah, thank you, Cody. And again, thank you for everyone joining us today. I know there's a lot of things going on, the news cycle with updates on the coronavirus on top of the financial market stress has been very intense. So the goal right now is to really kind of take a multi-pronged approach and talk about what has transpired in relation of the coronavirus situation and how financial markets have responded. Then I want to briefly go into our wealth management process as kind of a refresher on how we go through portfolio construction and how we prepare clients for times of these periods of financial stress. And then I want to spend the latter part of the conversation talking about things that we're looking at, where we're going to be going within the financial markets, and kind of that road ahead, what lies in front of us. As I think that there's good opportunities that will come out of this, but most importantly, there will be continued volatility and continued stress within the market, and patience is the name of the game. So with that being said, I first off want to take this moment to thank every one of our service workers out in the area right now, as well as our frontline and some of our emergency response teams. We have some of those as clients, we have some of them as friends and family, and our hearts are with them and our prayers are with them as they go through and battle this very tragic situation that's been going on. So other than that, I'm going to just kind of dive in. As we know, the markets have violently sold off since February 28th, or the last week of February, over the last 5 weeks. And it's been one of the most historic drawdowns that we've seen on record, not from a percentage point decline, but from the pace and magnitude of which it has come down. And that has been akin to a lot of the 2008. We hear a lot of 1987, a lot of these analogs to try to put perspective of the pace of the collapse. One thing that I want us to talk about today is something along the lines is we are business cycle investors. We look at market cycles to get an idea of how much stress is within the system. And we believe that while coronavirus is a very dangerous situation that's going on globally, the financial markets, as we've talked about with our clients for the last year or so, we've been experiencing late stage business cycle dynamics. And why I bring this up is that has a lot to do with the volatility that we are seeing. So as companies really did not manage cash very well, there was a lot of debt issuance within financial companies, from our banks, from other industries across our financial markets. That has now exacerbated this sell-off. And most importantly, as we get into this crisis, there has been a drastic halt in economic growth. And what we've seen is investors have done really a dash for cash. When that happens, we sell off every asset in the book. We sit there and say, hey, we don't want to own this asset, no matter how good quality it might be. We want those assets disposed of, because right now we are so uncertain of the economic growth. We want to hold cash. So what happens is valuation goes away, fundamental analysis goes away, and we lose sight of the long-term perspective and belief that we will get out of this crisis. We will move forward. It is just a lot of uncertainty at the point in time. It's uncomfortable, and it gives all of us anxiety. But that goes into our wealth management process. At Delos Capital Advisors, we design something very different in regards to how we build our client portfolios. the name of the game and state of the industry has always been sitting down with every client and going through a risk tolerance questionnaire saying, hey, how do you feel when you lose XYZ amount of dollars? Well, I'm going to tell you right now, no one feels good. And no matter what, with every asset class being sold off during this drawdown, everyone's risk tolerance is not okay. Everyone feels uncomfortable in these environments. And so instead of us designing portfolios that target returns or target risk, we sit there and take a capital needs or cash needs approach, and we help our clients insulate assets that are known as risk stability assets. And those are assets that just maintain stability, that kind of just flow nominal returns as the market draws down. And that comprises of short duration treasuries, cash, and then high quality AAA corporate grade bonds. And so by having those, that allows our clients to maintain funding stability if they need to pull assets out of the account to fund their lifestyle during periods of episodic volatility and financial stress that we're seeing currently. And that really helps clients stay within the seat, allows the other side of the portfolio known as risk assets, which are your stocks, your long duration bonds, your commodities, to recoup in value. And by putting those two components together, our clients then feel more confident and comfortable that, hey, we're going to weather the storm. Our financial plan has been executed. Our portfolio matches our lifestyle, and we're going to be able to move through. So that really helps kind of a portfolio construction perspective. I think one of the bigger points to also discuss is while the magnitude and drawdown have been very intense, this is a very different scenario compared to 2008. And I want to spend a few minutes on that. We're seeing a lot of analogs of 2008 type of situations pop up. And while liquidity has definitely been an issue, when I mean liquidity, everyone's running for the amount of dollars in the system because we want to hoard cash in our pockets. That has actually exacerbated a lot of the stress that we've seen. And by having all of that stress exacerbated within the system, we're experiencing that episodic volatility. Well, in 2008, that was all driven by consumerism. We had more individuals had 3 mortgages, or we had a person that was making $80,000 a year that was trying to finance $1 million home. What we're seeing now is not a shock that's coming from over leveraging on financials on consumer or individual household balance sheets. We are now seeing a shock to the system that is completely exogenous. It is a shock based on the coronavirus, and why it's being exacerbated is because a lot of companies in late stage business cycle dynamics did not have enough cash on hand to cover their expenses if revenue goes to zero. And that is what has happened. We've seen consumer purchases collapse over the last few weeks. Now, what we've seen though is that savings rates on aggregate are a little more elevated across households in the United States, and financial obligations are very low relative to where they've been over the last 3 decades. So while the consumer or why households are still going to experience stress from this situation, we are still in a better shape as a whole to help us get through this a little bit quicker. So we do expect the volatility to continue. There will be a little more drawdown ahead, but the recovery, hopefully, in the next 3 to 4 months will start to bottom out and give us a lot quicker of a recovery in financial asset appreciation than where we're seeing right now. So again, it's patience and make sure that we're allocating capital prudently. And right now we have not done this whole buy the dip mentality. We have kept all of our clients with excess cash, long duration treasuries, gold, and most defensive names or high quality companies within the portfolio that can withstand this type of volatility. And so by doing that, we will monitor the inflection points down the road to hopefully see when we'll get through this. And then we can start putting those defensive assets that we've been holding into more cyclical names or names that will perform better once we get out of the tail end of this process. I think the most important takeaway and the question that I get all the time is been to buy the dip, or when is it time to put money to work? And given where we're at right now with continued closures across the country and municipalities, we think it's important that investors remain patient. If you've already been invested, that's okay. Again, if you have that risk stability bucket and you have enough to cover cash flow expenses, and some of us will be fortunate that we don't have to use any of our assets to cover expenses, let these things ride through and we will make it out on the back end. So other than that, that's pretty much the updates that I have. Do you have any questions?
Yeah, so we have had a couple of questions come in, both from the emails we've sent out. So I'll just dive right in. I think this is a great place to start, given we do have several clients in the oil and gas and energy sector, also being in Texas. A lot of people focus on that. So just given that the energy market, what are your thoughts on the sector as a whole? And do you think, do you see places within the sector we should be avoiding? And what are your thoughts moving forward?
Yeah, that's a great question. So really kind of what sparked the most extreme periods of the volatility we've seen in the market was about 2 weekends ago when Saudi Arabia and Russia decided to engage in price war of commodity or oil. And now with them trying to ramp up their production, that has obviously put a lot of downward pressure on a price of barrel. And when that has happened, that is exacerbated through the energy sector complex because their break-even rates, or the amount of revenue they need to make off of selling a barrel of oil, is well below their profitability standpoint. And that has a lot of profound implications. So when that typically happens, a lot of those energy companies run off bank credit or bank notes to help fund their expansion through debt issuance. And the high yield market, or the bond market, that is the riskier side of the space, comprises a lot of energy credits. And what we're seeing is that because now price war or overproduction from OPEC and Russia, as well as now is a collapse in demand for oil. In fact, I read an article where the airlines are not even using all the gasoline that they've purchased. They're having to stockpile barrels of gasoline in warehouses until they can get the demand back for travel. So we're going to continue to see significant pricing pressures on oil, and it's going to maintain around this area, if not move a little lower, and it could very well be below $20 a barrel. That the energy sector as a whole is an uninvestable market, and one that will just take some time to rebuild, for credits to kind of price back in, and for the price of oil to restabilize. So energy as a sector itself is, if you're invested, it's the high quality companies that you want to stick with. It's the one that have a lot of cash on hand, the one that can meet those debt obligations that they're required to. But there is a significant amount of stress within the sector right now that will continue to be until we get more of that global demand or consumerism back up to where people are out there driving their cars. People are getting on that airplane to go to their favorite vacation spot. So for the time it's a high risk segment of the market that we tell investors do not add more capital to. It is a wait and see. And if you've already been invested, we want to make sure that you're invested in companies that have good quality balance sheets that can withstand what's going on in the markets today.
Don't let the idea of chasing yield pressure you into buying something. We get that question a lot. So.
Yeah, that's Andrew Smith, grind my gears, number one. We get a lot of investors that look at the dividends or dividend yields that these stocks are paying. And the phenomenon that we've had after 2008, when the Federal Reserve lowered interest rates so low, there was something called the Tina effect. There is no alternative. And that pushed investors that required income to go into the equity markets. Well, energy, MLPs, master limited partnerships, or some type of energy structure investment produced the highest income relative to the bond market. And so those yields would have been 8%, 10%, which sounds extremely attractive. But what we've always warned investors is that risk and return are always related. So when you go out there and you seek that higher yielding investment, what happens is that your capital appreciation still can decline by 40 to 50%. And what ends up happening is that a lot of these companies, when they go through these periods of stress, end up either slashing their dividend or cutting their dividend. And now it was a pointless investment. And we've begun to see that with a lot of energy companies and a lot of industrial companies that are cutting their dividend in the wake of this response to hoard and maintain cash on hand.
Perfect. Thank you. Second question, and I alluded to this a little earlier, and we've talked about this a lot, and it's on TV every day. But thoughts on the Fed actions that they've taken up to this point, because it has been unprecedented, correct? But also thinking, okay, I would like for you to speak to how the market's reacting to that, but also what do you think is really needed moving forward to help stabilize that foundation and allow us to move higher?
Yeah, clients are coming in with good questions right now. really, the Federal Reserve, in our humble opinion, has done a very good job of trying to provide as much liquidity to the market as possible. And this is done through a plethora of operations. And we won't get into those today because they're very highly technical in nature, but let's just assume right now that what they've done is they've tried to alleviate stress within the interest rate market because interest rates were starting to move higher. And in the net effect, that was going to tighten up consumers, and that was going to really kind of put investors or people that were demanding loans on the back burner because they weren't going to want to pay that higher interest rate cost. There's also the biggest phenomenon of the dollar liquidity situation, and this is probably one of the most important things that investors should be focused on is while the stock market has collapsed, what we saw was that investment companies, actual corporations, and individual investors or households were selling, as I mentioned earlier, any and all assets to hoard cash. There's only a certain amount of dollars within the system. And so that ends up causing our currency to rise in value. And because currencies trade and pair with other currencies were collapsing. Well, a lot of debt across the globe is priced in US dollars. So emerging markets, when they issue debt, it's priced in US dollars. Commodity prices are priced in US dollars. So every time one of those assets is liquidated, it is another demand for dollar. So what the Fed has done has come in and said, hey, let's try to shore up confidence, but most importantly, shore up liquidity by maintaining purchases of our treasury bonds, which helps keep interest rates low, which will help fund hopefully more liquidity within the dollar. So that helps soothe pricing dislocations, which is what we believe exacerbated a tremendous amount of volatility over the last 2 weeks. Now, the efficacy of what they're doing right now, obviously, we won't know the true range of outcomes if it was good or truly bad for economic growth for years to come. But right now, it's what the market demanded. It is what the market needed, and it's not done there. As we can see this morning, the Fed engaged on what we call endless quantitative easing. They have now taken the approach, we are going to do whatever it takes to help shore up the confidence and maintain liquidity within the market. And now the market is waiting for that fiscal response. We are waiting for the Senate to approve that spending bill that can help send checks directly to households, that will help small businesses get their loans so they can maintain employment. It's going to help people bridge so they don't have to go file for unemployment or initial jobless claims. And so that fiscal policy in conjunction with the monetary policy will hopefully provide enough stimulus because it's the largest package that a major developed country has initiated in this coronavirus pandemic. So we think that there's a lot of positives that will come through once we get that policy piece, fiscal policy piece put in place. And we do think that that will help soothe more confidence within the market and potentially lead us to what we think is a bottoming process.
Great, thank you. Last question we've received, and then we'll go into our conclusion. But we've talked about the process. When does buying begin again? When do you believe? What does that look like? And what you mentioned patience, and that's me talking. But when do you think that is part of our process we'll start to look for those opportunities?
Yeah, great question. So one of the most important things that we see right now is everyone tries to always time markets of when to get out on the top and when to buy it on the bottom. And it's an extremely challenging game to try to get both right. And so what we do is we look at a lot of indicators that give us good leading in their analysis or assessments of when things will start turning within the market and when those positives will become. And so we run a few mathematical models to help give us that sense or that idea. What we've seen is that right now our capital markets, our financial markets are highly dependent, as they've been on the monetary policy, on the fiscal policy. But now, most importantly, we are dependent on the growth rates of this virus spread. So market, think of it as a sentiment indicator. If we're not feeling comfortable about the market, what do? We sell our assets. And so we need that last leg of confidence to come in from a reduction in growth rates. So that means how many net new cases per day or per week from the actual confirmed cases, but also mortality rates. And so we hope that the lockdowns that have been occurring in municipalities and in some states will help reduce the community spread that's been going around, which will help limit the number of people that get infected and therefore provide that confidence to the market that, hey, things will be okay. Now, the most important thing here is that that's not the only piece of the equation. The next piece is there is economic data that we have to be mindful of. Right now, it's anyone's guess to how detrimental economic growth will be hit. And we need for that economic data to come in, and we need to digest that so we can get an assessment of what assets should be priced at. And then we'll get an idea of when it's time to start buying into the market. Human nature is a very important part of this process. Assets have been panically sold for liquidity needs or hoarding of dollars. Once we get through this kind of relief rally from what I mentioned, fiscal policy, monetary policy, which will come, this market will then have to consolidate and digest the economic reports or the aftermath that comes. So we look at it as a post-war reconstruction situation, right? The war has ended, everyone's really happy, and everyone's, euphoric and feeling good, but there's still a lot of rebuilding that has to take place, and it is a process for the markets to recoup and kind of get that solid footing. So there's not necessarily a time frame, but by looking at leading economic indicators via the conference board and also looking at the fiscal policy, monetary policy, and the growth rates of the coronavirus, we think we have a pretty good data set or model built out to give us the idea of when we can start really taking advantage, reducing our defensive posturing, and getting into more risk assets that will benefit from the uptick in economic growth.
Perfect. Thank you. That's wonderful. So, and just to add quickly to that, please note there is a process behind all of this. There are so many things we're looking at on a daily basis to find those opportunities and do this in a way that is prudent, so that we are protecting that wealth that you have entrusted us with. So, in conclusion, if you are a client of Delos Capital Advisors, please be looking in your email today. We've talked a lot about the strategy, but also the process, and a lot of that process revolves around our Delos 360 financial planning. And so Thomas Keeling, our Director of Financial Planning, will be sending out our questionnaire again today. Many of you have filled it out. And so if you have, we just want to make sure that we're updating your client portal. We're keeping your financial plan up to date. And in times of like this, of stress, of uncertainty, you may see some details that you might have missed. So please respond to that email. You don't have to complete the questionnaire again, but just keep us up to date. If you have not completed the questionnaire, we would ask you to do so. We do believe it is vital for your long-term financial success. Not only for us to be able to do our job, but for you to have a better understanding of truly what life looks like, and then how can we utilize that and invest around your life. So on behalf of our entire team, Andrew and I, Kramer, Christy, Thomas, thank you so much. Thank you for your trust and your support. We are here working harder than ever for you. And if you need anything from us, please reach out to any of us. We are here. We will continue to be here, whether it's in this office or, like I said, we'll be working remotely for the next couple of weeks. But we hope to hear from you. We want each and every one of you to stay safe and stay healthy. And we'll see you on the other side. Thank you.